Good afternoon and welcome to the Morrows Monthly update for December. The month of December was an interesting one for markets, with the US Federal Reserve announcing that it would taper its stimulus program by $10 billion per month. Equity markets unexpectedly rose on this announcement, and the anticipated Santa Claus rally took hold, with 2013 proving to be a very good year for equity markets. The Australian equity market recovered from earlier losses during December to finish the month up around 1%. Global equity performance was also quite strong across developed markets, with Japan up 4%, the US up 3% and Europe up 1%. Emerging markets didn't fare as well, however, with China finishing down around 5%. Global bond yields continued their upward trend, with the benchmark US 10-year Treasury yield hitting 3%. Almost double where it was back in May 2013. Commodities were generally stronger, with oil prices higher by around 5%. Gold, however, continued its decline, finishing the year down around 28%, its worst annual return since 1981. The US dollar was weaker against the euro and the pound, but trended higher relative to the yen and the Aussie dollar. The Aussie dollar slipped by around 2% against the US and was also weaker against the euro and the pound. US economic data was generally positive. The manufacturing sector expanded, retail sales were stronger than expected, third quarter GDP growth was revised upwards, consumer sentiment picked up, and industrial output was strong. The unemployment rate also hit a 5-year low of 7%. Data out of Europe was somewhat mixed, with manufacturing expanding and consumer sentiment picking up. However, industrial production was lower than expected and the inflation rate was marginally negative. Data out of China was also mixed, with manufacturing weaker than expected. However, trade data, retail sales and industrial output were strong. The inflation rate also fell to a 3% rate. In Australia, manufacturing contracted, business confidence was weaker than expected, as was consumer sentiment, and the unemployment rate rose from 5.7 to 5.8%. On a positive, retail sales rose more than expected and the housing market continues to be strong. (2013) proved to be another strong year for investment returns, with investors looking beyond the short-term macro headwinds and focusing on yield in an environment that wasn't favourable to investors holding cash and term deposits. For the year, the Australian equity market returned 17% and the US equity market returned 30%, its best year since 1997. Poorer performing investments included commodities, and in particular gold, and also government bonds. As we look to 2014, short-term focus will be on US fourth quarter corporate earnings and also raising the debt ceiling. On a medium to long-term basis, focus will be on valuations and also the sustainability of the current market rally. For markets to move higher from here, we really need to see an improvement in economic fundamentals and corporate earnings. So the next few months will be quite interesting. We look forward to talking to you again next month. Thank you.